Good morning, and welcome to the Energy Perspectives Group webinar hosted by Kolibri Global Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Hey, welcome everybody. I think we have about 30 people on. We got a few more people just logging in now, so it takes a couple minutes. But anyway, give them a second here. Okay, I'll go start with the introduction. They can catch up. And we are recording this, so a link to the recording will be sent out later this afternoon. But anyway, today's webinar is hosted by Kolibri Global Energy, one of the rapidly growing companies in our small cap growth portfolio. Finding undiscovered small caps with this much near-term growth potential is why you pay me the big bucks to be an EPG member. We've made our biggest gains have been on some of these small caps that we find before the Wall Street gang figures it out. Anyway, I've been following the company now for over a year, and they've made a lot of progress during that time. Here are some key points that I want to make before I turn it over to Wolf Reniger, the company's CEO. But for its size, Kolibri has a significant amount of low-risk, high-return development drilling locations, which I refer to as running room. I use that term a lot, and it has a lot to do with my valuations of especially small caps. And all their producing assets are in the central Oklahoma Scoop play, just west of Oklahoma City. Based only on total proved reserves at the end of 2022, they had 26.2 million BOE, 74.9% light oil. The company's PV10 net asset value of just their proved reserves, less all their debt, was $13.68 US per share, way above where it is trading now. Now, last year, the PVN, at the end of last year, that was based on, like $90 oil price. So, but this year's report should show a lot more proved reserve volumes. So I expect, a PV10 value close to that or above that at the end of 2023. The company's revenues are heavily weighted to oil, which is a good thing in today's market. And then they sell their oil for about $1.50 per barrel discount to WTI. Heading into 2023, they had 60 proved, 63 probable, and 57 possible horizontal drilling locations within the Tishomingo field in Oklahoma. And I believe that all these development drilling locations are in the Caney Formation, which is where most of their production comes from. Below the Caney Formation are the T-Zone and the Sycamore Zone the Sycamore I know is productive in that area. The T-Zone could more than double the company's recoverable reserves. We'll spend some time talking about that today. And the 2023 drilling program included 2 horizontal wells that were completed in the T-Zone. They currently have 26 wells on production and 3 more that should be completed in November. Maybe one of those drips over to December. But the 2022 production was 1,638 BOE per day, and they are on track to almost double production in 2023 to 3,250 BOE per day, as they head to a 2023 exit rate of over 5,000 BOE per day, about 73% oil. Key to my stock valuation on this one is that they are now funding their steady production growth and reserve growth with operating cash flow. That is key for small caps, that they're not growing based on debt. The company's common stock recently uplisted to the NASDAQ, also a big plus for this one. It trades as KEGI. So KGEI. KGEI.
No,
okay,
you got it right. That's right on the screen.
Okay, all right. Okay, great. I have it opposite in my notes. Anyway, our speakers today are Wolf Reniger, the company's president, CEO, and Gary Johnson, the company's CFO. Wolf Reniger brings over 34 years of conventional and unconventional E&P experience to the company, most of the time in senior management positions. Prior to joining Kolibri, he served as executive vice president of Bankers Petroleum Limited and president of his wholly owned subsidiary B&K Petroleum that was spun off in 2008. And Wolf, that's what's turned into Kolibri, right?
Correct.
That's
correct.
correct. Okay, so
the
it's
US
really the
assets.
same company.
Yeah, correct.
He has an extensive operations and finance background. Has been at the forefront of BNK Petroleum's acquisition of unconventional gas projects on an international scale and development of the company's Tishomingo field in central Oklahoma. He holds an economic degree with an emphasis on computer science from the University of California, Santa Barbara, and has served on the board of directors of the California Independent Petroleum Association for over 25 years. Gary Johnson is the company's CFO. He's a CPA and brings over 25 years of accounting and finance experience, 17 years in the energy industry to the company. Prior to joining Kolibri, Gary's career has included roles with Occidental Petroleum Corporation, a Fortune 200 New York Stock Exchange company and a very big player in the Permian Basin, as director of technical accounting, where he was responsible for the company's public filings and worldwide accounting compliance. He's a graduate of Loyola Marymount University with a Bachelor of Science in Accounting, and he also holds an MBA from Auburn University. So with that, I will turn it over to Wolf, and I will go on mute. And then when he's done, I will come back. I have a list of my own questions, but if you have any questions, you type them into the chat box. You can get to the chat box just taking the cursor on your screen and going to the bottom of the screen, and it will pop up, and you can just click on that and type your questions in there. So I expect to have a lively Q&A discussion today. So I will go on, and Wolf, it's all yours, buddy.
All right, thank you. Appreciate the introduction, and thanks everyone for joining. And go on to the stuff that's ours. This first page is all EPG. Forward-looking information, all these slides are on our website as well. But forward-looking information, disclaimers, our forward-looking or non-GAAP calculations, etc., are all on there. So Dan gave a great introduction, so I'm not going to dwell on things too much. I'll just hit the highlights. As you mentioned, we're in the Tishomingo field in Oklahoma. We're unusual in that we have a large amount of proved undeveloped reserves. So our reserve split, you can see down here, is 18% at the end of last year in the proved developed producing category versus 82% is in the proved undeveloped category. And I think that's one of the reasons that we were undervalued, and that is slowly being rectified, but we have a long way to go in our opinion. We are up from 10% in the previous year. So by drilling a number of wells last year, 5, we moved from getting the PDP from about 10% of our proved number up to 18%. And that's assuming everything stays the same on a reserve basis. And as Dan said, we have hopes that our reserve report at the end of this year will actually increase our proved undeveloped even further. Dan hit the highlights, as I mentioned. Low debt, cash flow is growing. We're just looking at mainly using cash flow to drill our wells, not looking to raise any equity, keeping our debt levels low, ratios of debt to EBITDA low. And then in the future here, we're looking toward working everything with a view toward returning capital to shareholders, even while we're still increasing the value of the property. Originally out here, we drilled the Woodford Shale. If you look here on the screen on the lower right-hand side, you'll see where our acreage is at 17,000 acres. Originally, we had developed this for the Woodford. We drilled 40 wells out here, 1 in each section, basically, where we're operator of about 80% of them. Exxon was buying up everything around us. So they picked up 280,000 acres out here. We were the last holdout, and we had just put our first horizontal well into this Caney formation that's about 300 feet above the Woodford. When they kept hounding us to sell, basically, and we finally said, okay, we'll sell you the Woodford. So we sold that to them for 147 million when we had about 12,500 acres there, but we kept the rights to the Caney and the Upper Sycamore. No one else out here did that. It was just all on ours. And you can tell the Woodford was obviously a lot more gassy from this chart. It was only about 15% oil. And now we've moved to mainly being an oil producer. So about 75% of our production now is oil. And the areas we're drilling varies between 75 and 80%, actually. So we've really been transformed from being a natural gas producer to an oil producer. As Dan said, oil, we get WTI pricing less about $1.85. And then the gas and NGLs, we had sold a third of the gathering system that we had in the field to Exxon when we sold them the 12,500 acres in the Woodford. And they now market and sell all of our gas and natural gas liquids. And so we just pay them a compression and a gathering fee for that. I think he spoke plenty about my background and 36 years in oil and gas in general, all sorts of roles. Gary, same thing, 30 years plus in accounting and finance. The two people we didn't mention yet that are also key to our success out here, Greg Presley, our Vice President of Engineering. He's done a great job, as have Alan, our Senior Geologist, in just not only defining the field, but now getting better and better at developing the field. Constant improvement is something that we completely believe in. And they've done a good job, a really good job for us. Board of Directors, I'll touch on briefly. David Newhauser, Managing Director of Livermore Partners. He owns about 14% of the company. So he has lots of experience on the capital markets and M&A, et cetera. Eric Brown, he's our CPA equivalent in Canada. It's called a CA. He's head of the audit committee. Leslie O'Connor used to reservoir engineer, used to run MHA Petroleum and Sproul's Denver office before she retired. She's been retired for 5 years or so, but lots of oil and gas experience, lots of reservoir engineering experience. Evan Templeton, ex-Jefferies, high yield senior credit analyst, brings lots of, again, oil and gas experience, markets experience, and debt experience to the company. And then Doug Urch just recently joined here in the last 2 weeks. Great experience as well. He's a chartered professional accountant, lots of years in oil and gas on the accounting side of things as well. Just I'll touch on this a little bit, where we are trading. I think we're down a little bit from these numbers here, but roughly 445 is what I was using for the share price calculations and market cap calcs. So in US, since we're a US group here, 159 million, as Dan pointed out. NASDAQ listed here about less than 2 weeks ago, or about 2 weeks ago today, actually. Was our first trading day on NASDAQ that we got uplisted, and we actually got to ring the opening bell at NASDAQ, which was fun on Monday morning. Great experience on that one too. So we're looking to get more volume in the US side of things, much larger market. So hopefully we get much more liquidity in the stock, and more people get recognize, you know, the value of our shares and of our company, I should say, overall. And hopefully that share price increases to where we think it should be, because we definitely think we should be undervalued. Try to keep debt levels low. And as Dan mentioned, you know, if you look at our proved reserve number, end of last year was 500 million, right? And versus we're trading at a US market cap of about 160 million. Now, even if you don't trade at 100% of those numbers all the time, we still have a long ways to go to get caught up to what our asset value is. And as Dad mentioned, the numbers as far as dollar amounts per barrel on the valuation for that $515 million number, and it was basically $86 is what they were assuming in 2023, 84 in 2024, 80 in 2025, and dropping down to 81, 80, and then back up to 83, 84, 85. So it was in the low 80s. So, you know, in the ballpark of where we are now. So we're very comfortable with this proved number, and hopefully we are able to increase that further. But I'll get in that in some later slides. I'll let Gary take our forecast here.
All right.
Gary, you want to take over? Yep.
Thanks everyone in EPG for joining the call as well. So we put this updated guidance out a couple of weeks ago, and the main factor for the change in guidance was just timing from the original forecast. Since we have the two latest Barnes wells coming on earlier in that forecast. And then we also added a well at the end of the year that wasn't included in the original forecast, which did push back when these last few wells are going to come on. We're going to come on production in the original forecast. So, and then we also did have some field gathering issues, which temporarily reduced production, but those have been mostly resolved now. So for the forecast, all amounts are in US dollars, and we use an $80 oil price for the fourth quarter. So we're forecasting average production for the year to be between 3,100 and 3,400 BOE per day, which is an increase of between 89 and 107%. The forecasted production exit rate for 2023 is between 5,000 to 6,000 BOE per day, which is a 25 to 50% increase from the 2022 exit rate. CapEx is expected to be between 51 and 56 million, which is an increase of 37 to 51%. Revenue for the year is expected to be in the range of 57 to 62 million, which would be a 52 to 65% increase from the prior year. And then we are forecasting adjusted EBITDA to be between 45 and 50 million, which is a 79 to 99% increase from the prior year. Our net debt is forecasted to be 24 to 26 million, which is an increase of 43 to 55 million from the prior level. And that's mainly due to, we're using that for working capital. So we're doing a lot of expenditures at the end of the year. So that's ticking up a little bit at the end of the year. And lastly, the forecast for enterprise value to adjusted EBITDA is 3.75 to 3.38. And now I'll hand it back to Wolf for the rest of the presentation.
Thanks, Gary. And yeah, here on this right side here, you can see where our adjusted EBITDA, from 2021 to 2022, we almost quadrupled it. And then we're looking to just about double it again in 2023. So everything's moving along the right way. Production-wise, on a quarterly basis, you can see how everything is increasing up. Second quarter exit rate was about 3,500 a day. And we're just growing. So we hadn't drilled wells here in about 3 years. You can see how it was declining, but a slow decline. So it wasn't have a really hard decline on us. As wells get older out here, the declines are obviously less. And everything's just moving up. And here's our net operating income on a quarter by quarter basis. And this is basically, when new wells come on, you get kind of a spike up and then things come back down again. And we did have some issues here as far as timing goes on the wells coming on, and as some gathering issues in this last year a little bit. So we'll talk about that in a little bit later. Oil price wise, you can see even while oil prices were up and then came down, our operating net income was still going up. And then go into our production curves. So when we were drilling in 2022, these are the 5 wells that we drilled that year. When we came into the year, or before we started drilling, Netherland, Sewell had estimated that our type curve of what the estimated well should produce, so 1 mile horizontal, as Dan had pointed out, which is what all these are, was about expected to come on around 400 BOE a day. Because of a new fracture stimulation technique that we had put in place, we drastically outperformed. And I'll give you a short version of it. We were using a linear and a cross-linked gel, which makes a really thick, viscous carrying fluid for the proppant. And what that does was it creates thick, long fractures that go out a long ways. What you really want to do in order to maximize your productivity is keep your fracture stimulations in close to the wellbore. So like a slick water type frac would be your ideal case. And so what we did was we went with what's called a high viscosity friction reducer in order to carry the sand into the formation. It's just a much thinner fluid, but it carries the proppant really well still. And then it also doesn't leave any residual on the rocks. So what we did was we used that, and then we are also using what's called diverter. So when the fractures start going out too far, you put some diverter down there to stop those fractures from going out, and you start new fractures in a new direction. Bottom line is the combination of better drilling in the right, sweet spot of the formation, along with the new fracture stimulation techniques that we were doing and just refining it over the years, was led to production last year being between 600 and 1,000 BOE a day for the initial rates, much, much higher than where it was. So these wells really drastically outperformed. I'll touch base on a little bit on the reservoir itself before I get into some of the other nuances here. You can see over the years, Netherland, Sewell has been increasing the amount of estimated recovery per well year after year after year. So that, to me, always, when you see that, it shows the sign of a good reservoir. So it's not getting worse, it's getting better. So what they estimate their curves and their decline rates every year, they've moved that less and less decline is what they're estimating, because the wells are performing well. So the longer we've had wells on, the better the recoveries have been over the years for their estimations. So that's always the sign of a good reservoir. Our drilling program for 2023, which we're toward the end of here, right? We're downspacing the field into the lower Caney. So when we downspace wells, they're not going to generally perform quite as well as when you're not downspaced, when your wells are further apart, because you do have some interference with one another. So we were estimating that it was going to be about 75% of what our average 2022 well is. And so far, that's what's holding in there well. We had also, not only in the Caney, but we tried a well in the T-zone, which I'll show you a little bit more on the next slide, which is an additional interval that's right at the base of the Caney that we felt we weren't accessing. And that can add a lot of reserves, because right now, Netherland Sewell is only giving us credit for the Caney itself, not for this. We were drilling wells for 6.5 million on the first the first 3 wells that we did on a downspaced pattern, which was down from our estimates of 7.2 to 7.4 million. So that was a big savings. And that was while even casing prices were still quite high. And so our total forecasted program, we expanded it to 9 wells, 8 wells on production. First 2 sets of wells were on production already, and the next 3 wells are actually finished drilling at this point, but will be coming on production here in later in November. So talking about the T-zone, just to give you a little graphic. So we have the Caney here, and then the bottom of the Caney, we've broken it out into what we call the T-zone, because we discovered there's a fracture stimulation barrier here in between the two. We had some early wells that we drilled into the T-zone, but they declined pretty hard. In difference in completion styles between what we were doing then and now, these were very understimulated when we did them. And so we said, look, with the success that we're having in the Caney and how much better our stimulations are going in the new stimulation technique and how much better they're performing, we thought a high degree of success would be had by us in the T-zone, where we could make good economic wells with our new fracture stimulation technique. So we did that in the first 3 pad wells that we drilled. We drilled 2 in the Caney. We did 1 in the upper Caney, 1 in the lower Caney, and then we drilled 1 into the T-zone. So we fracture stimulated them all at the same time. And the early data that we have from the T-zone looks like it's going to be a good economic well. So our next pad, our next downspacing, was only in the Caney, because we didn't have enough data yet from the T-zone to say, yes, we should spend the money on another T-zone well. We got enough data from that, and so that's why we have another 3 pad going with 2 lower Caney wells this time, because the upper Caney didn't perform as well. We found out when we fractured stimulated upper Caney and the lower Caney that really the lower Caney is stimulating all the way up into the upper Caney, and it's more efficient for us to just do lower Caney wells, and we'll still get all this oil in the upper Caney, and we'll make better economic wells, was our belief. And that's what looks to be true based on the last results that we just put out a couple of weeks ago about the 2 wells that are downspaced in the Caney. And then, as I mentioned, we drilled 3 wells in the lower Caney, 2, and then 1 in the T-zone that'll be coming on here in November sometime. Touching base on what Dan had mentioned too, 60 proved locations we came into the year with, 63 probable locations, and then 57 possible locations. You'll see that the darker green here are all the proved locations, right in the heart of what we're doing. There's some probable locations here on the edge that Netherland Sewell doesn't give us credit for, because we haven't drilled out here. There aren't any wells in the Caney out here, so they only give us credit around here. So my belief is that if we drill out here, we'll start converting these to proved locations as well. And then eventually we can start drilling some wells out here to test if we can make economic wells out here with our new stimulation techniques as well. A little bit riskier because it's a little shallower, but we have a chance to even get reserves out all the way on the side here. 17,000 acres plus, all held by production. all held by production because of that deeper Caney or deeper Woodford, excuse me. So when we drilled those initial 40 wells, sold to Exxon, Exxon did more drilling in there. So they're holding those leases for us, even where we don't have any Caney wells, which is great. So infrastructure is all in place. Kind of spoke about that earlier already, so I'll just skip that. Netherland, Sewell's reserves cover this area only. They don't cover any of the analysis out here yet. So that's future upside potential as well, although a little riskier, I will say. Just where we've drilled, the first 3 pad that we drilled earlier this year, the Barnes 8-1, 8-2 were both the Caney wells, and then the T-zone of the 8-3. Then we drilled and announced on production here a couple of weeks ago, the Barnes 7-4 and 7-5. These are located here. These are both lower Caney wells and came on very well. I'll show you a graph on that here in a little bit. And then what we're drilling, or just finished drilling, I should say right now, the Emery 17-3, 4, and 5. 2 of them are the lower Caney wells, and there's 1 T-zone well in between. And then we'll have 1 more well that we start drilling in December, which will be the first of the next 3 pad, which won't come on till next year, but the first well should be drilled this year already. So it's in our CapEx for the year, but it won't add to any production yet this year. But the good news is it'll come on early in the next year. So we won't have a big lag between when 1 set of wells comes on and then the next set of wells. We should be much more consistent next year on that. So you have less fluctuation in your highs and low of the production overall as it's growing. As I mentioned, we were looking at our estimated for the year on the downspacing was that we were going to average about 75% of last year's average wells. So this green line is 75% of our best well. And this green line here is 75% of our poorest performer last year. So all these wells should be somewhere in between here is what we're estimating, which is this green expected range here. And then you'll see up here our Barnes 8-2, the 1 lower Caney well came on. This was some of the issues we were dealing with the gathering system out here, where wells weren't performing quite right because they were having gathering system issues. But it's popped back up nicely to the lower part of the range. The Barnes 7-4 and 7-5, these were the first week IPs, but they were performing well, so we expect them to stay in this upper range here, even for the 30-day rate. But we'll announce that once we actually have a full 30-day rate on everything. Early indications are they look really good. It's going well. So with that, I will move on. Oh, there's the last ticker. Is our enterprise value versus NAV, the comparison of why we think we're undervalued. These are all Canadian comparisons, I will say at this point, because our reserve report is per the Canadian specs. They use the Canadian oil price versus just using the fixed price of last year. And there's some other little tweaks between the US reserve reporting and the Canadian reserve reporting. So just to compare apples and apples, next year we'll do a US report as well, so we can compare ourselves to some of the US players as well, which I think will stack up extremely favorably as well. But you can see that the average that they trade at is about 55% of what the NAV is from the end of the year reserve report. We're trading about 27%. This is on the proved basis. On the 2P number, on the proved and probable, we're trading about 47%. So in both of these cases, we should be well over double just to get up the average. So we looked at said, why are we lower? Well, like our operating netbacks are higher than the comparisons by a long shot. So I'll make the argument that we should actually be trading higher than the average of our netbacks if we're making more money per barrel. But even getting up to just the average would really be a big increase. As Dan mentioned, year-end reserve report, per share valuation on the proved and the probable reserve is far higher than where we're trading right now. Moving on here, our G&A has been coming down on a BOE basis year after year. Our OPEX, our operating expenses per barrel, we're on the lower end, or the lowest, actually, I should say, as far as our peers as well. And if you look at this, these ones down here are actually natural gas producers. So their lifting costs are far, far lower. One of the nice things about our field is that we have low OPEX. One, we're quite efficient, but 2, the field doesn't produce a lot of water. A lot of these areas like Permian and some of these other areas still produce a lot of water per well. When we were producing about 1,000 barrels of oil equivalent a day, we were only producing 100 barrels of water a day out of the field. So that really helps on an operating expense side of things. We don't have to build large water infrastructures or anything else to dispose of the water, or frankly, we don't even make enough water so we can efficiently recycle 100% of our water for a frac job, because we don't get that much fluid back out of our formation. This is a slide that confuses many people because they're like, oh, you're going to bring production up to 4,000 BOE a day and you're going to hold it solid there. It's not what this is for. This is to say, a lot of people think shale gas, oh, decline's hard. How many wells are you going to need to hold something there? So this is really an illustrated development saying, look, what does it take to get to 4,000 BOE a day with our assumptions? This was done at a $75 oil price. This was done early in the year. This was done with a $7.2 million well cost. As we mentioned in the July 7th press release, these recent wells were drilled for $6.5 million. And we're hoping to beat that a little further as the year goes on, but we'll see how that goes. But even at a $6.5 million well cost, that's a big savings over the 7.2. That's the assumptions in this hypothetical scenario. So this was going to be 6 wells in 2023, 2 in 2024, and then 3 in 25 and 26. So we were estimating, based on our forecasted decline curves, it would take about 3 wells a year in order to hold production at 4,000 BOE a day. And even at a $75 oil price, after we take out the capex of what it takes at the 7.2, mind you, we would be generating 35 to 40 million a year in adjusted EBITDA after the capex. So it just shows you what this field can potentially do. Reality is we're going to drill more wells in these years than 2 or 3 a year. And then what we do with the extra cash flow, as I mentioned, we will be at some point in time considering whether we do dividend payments or do stock buybacks, etc. once we get to that stage. So, but we're growing the right way. As we mentioned, 60 approved locations. That's without the T-zone. I'm hoping that, year end, both these T-zone wells do well. Netherlands Sewell sees that as well, and they start giving us extra reserves for the T-zone, which could be significant out here. But we'll see what they do. If they just give us some offsets right around each of the ones that we drilled, or if they connect the dots between the two, because the T-zone is consistent across the field as the Caney is. So in our view, we should have proved reserves all across the field instantly for the T-zone, but that's not a guarantee that a third-party engineering report done by Netherlands Sewell will show that as well. It may take a little longer, but we should get a bump up. It's just a matter of how much bump up, assuming these wells are economic going forward. And that's pretty much it. So with that, I'll leave it on this slide and take it from there. Turn it back over to Dan.
Okay. Oh, it took me a minute there to unmute.
Yeah,
Yeah, Sabrina sent me a text. Her electricity went out. She lost the things. She was freaking out. we had screwed this up, but anyway, it's gone fine. Good. I could hear everything really well, and great presentation. Yeah, I've got several questions. A lot of them are kind of pointed toward how I do my forecast model on it, but one of the things I know was a little concerning was how production was down last summer due to some midstream problems. Can you tell us what caused those problems, and is that your problems, or that's your midstream gathering company that takes your oil and gets it to market?
Yeah, it's the midstream. So it's what it was is, near as we can tell, there's a lot of moving parts in a gathering system, right? So
right.
They were upgrading their compression, going and changing it to all the control valves and everything running straight on electricity instead of gas. So they had some issues with converting that over, apparently. And then there was a bunch of hot weather, which always causes issues in compression in general. It makes them less efficient. And apparently there was a lot of issues downstream as it was even out of their control, where pressures were backing out because of all the heat that was going on. And then also at the same time, they brought on a bunch of production downstream that impacted the gathering system as well. And what that does is it backed up the pressure in our field. And so we use gas lift for producing our oil and gas out here, because we use our own gas and just rent compressors at each site to help you know, when the pressures go down, to lift up your production instead of having like the horse's head that you normally see as a pumping unit on top of there. We found it's far less maintenance and much more efficient in how we're doing things. But when the pressure in the gathering system goes up, that creates a back pressure in the field, and thus it's not as efficient, and we get back pressure on the wells, which means our production drops off. And it was pretty high, the pressures that they got, to the point where we actually had to shut in for a few days. They got that back ongoing, but there was still some reduction in production for quite a while as they worked out the bottlenecks of, you know, the various things in the whole gathering system and the downstream side of things. It's not perfect right now, but it's not a major impact on us. Our production could be a little bit higher still, but it's far, far better than where it was. And so we're still at a tiny bit of an impact.
You think it's been pretty much resolved? And
yeah, it took a little longer than we thought, but like I said, the major problem was eliminated fairly quickly. Like, that's when we put out the press release as well. We still had some leftover after that, but it's a smaller impact at this point, you know, going forward since that.
But is it still, you think you got the summer heat problem still?
No, I think it's just there's so many moving parts that's hard to tell, and we're not in control of it, so we can just hear what they have to say about it. They're working on it. It's a small impact at this point. It's, you know, 2 to 5% maybe that it's impacting our production. And
but
it's not taken away forever. It's just the immediate flow on it. So,
but the volumes that they can handle in this gathering system can grow as fast as you're growing production. I guess that's the key.
Yes, that's what that was my main concern, and we've had a number of conversations with them about it, because we do have other outlets out here, and it's basically, look, if you guys can't handle it, it's just, we can build a gathering system and we don't have to build very much of it in order to get it out. We have other options out here. It'll take you know, a few months in order to lay that in place, but they assured us that they can handle everything that we're going to bring on here over the next couple of years.
Well, so, I mean, stuff happens in the oil field, people, and sometimes you have to deal with weird stuff. And we did have a very, very hot summer. So anyway, so I'm glad to hear that's resolved. And I'm also glad to hear that you're going to be more consistently bringing on these 3-well pads, so we shouldn't have any big dips while we're waiting for the next batch of wells to be completed, right?
Yeah, this year, I mean, in 2023 we had some pretty good gaps between bringing on wells, like at the end of 2022, right? And then it was a while till we had the first wells coming on in 2023. And that's why the starting to drill in December, where we'll have one done, that rig will stay, and then it'll just, from that same pad, drill the other 2 wells in January.
So at the end of this year, you'll have 29 wells online?
Yes.
Right.
But then we're completing another 3 early in the first quarter.
Right.
Okay, good. In your October 10th press release, you provided full year production guidance of 3,100 to 3,400 BOE per day for the year 2023, which, by the way, is almost double what your full year production was in 2022, just to let everybody know, and a 2023 exit rate of 5,000 to 6,000 BOE per day. I'm using the midpoint of those numbers for my forecast. So do you still feel pretty good about that guidance? Yeah,
I mean, it depends on how these 3 wells come on, but we like the location of them. These last 2 came on at good rates, and we think they're hopefully going to stay like this for the 30-day rates, pretty close. So
those lower Caney wells come on at like 6,000 barrels a day.
600.
Not 600. I'm sorry, 600.
Yeah. 6,000 would be nice. But.
Yeah, that would be nice. That would be a massive, let's see, Delaware Basin well or something. Okay. My forecast model shows the company's operating cash flow should be approximately 44.4 million. I think you had an EBITDA number, but that's my adjusted operating cash flow number if WTI averages $85 per barrel in Q4. Is that what you're expecting? And will Q4 operating cash flow cover the quarter's drilling and completion CapEx for the quarter and going? And then you expect to live within cash flow going forward, correct?
We do expect to live in cash flow going forward, and you'll see that you know, our exit rate on our debt is a little higher. And as Gary pointed out, you know, that's from a working capital point of view, right? Because we are spending a bunch of money right in the fourth quarter
Right.
And then some of that will get paid back from the production from all of our production, I should say, over the next few months after
Yeah,
that.
one of the guys on the call posed a question. What's the interest rate that you're being charged on your debt? And then you or Gary might mention, where do we stand on what's your debt limit, and how much have you got drawn against that revolver?
Okay. Yeah. So sorry. Go ahead, Gary.
So the interest rate is we pay SOFR plus about 350 basis points right now. So we're paying 8.8 to 9% currently is our interest rate.
Okay.
And then our facility is 40 million, and that we can borrow, and we're at, I think, 24 million, but we're going to be borrowing some more in the fourth quarter here. So
okay, but you have plenty of liquidity to.
Yeah, like I said, mainly it's because we're spending so much money in such a short period of time that we cannot fund all that through operations right now. So we use the debt to work for working capital, and then we'll it'll adjust down when we catch up.
Yeah, what's the lag on getting paid for your production? I know you sell your gas and NGLs through Exxon, correct?
Yes.
And then how do you sell who buys your oil?
Oil just goes to various vendors that we have a deal with. I'm not going to say the name here, but we go to bid every once in a while out here, and there's a number of loading racks around, and they all are within 10 to 20 cents a barrel of what they're offering. So getting it out of there, so that's why it's $1.85 less WTI basically, which handles all the trucking and everything else.
Oh, okay, that's good. Good. So it's good light oil, and there's good access to market for it, right?
Yeah, it's in the 40s, and my presumption is that it probably goes into a pipeline, goes to Cushing, which obviously needs the oil from the looks of everything I'm seeing.
Okay. So you're planning to say all the new Caney wells will be in lower. I'm glad to hear that you think that's draining the entire zone at the bottom. So that's good. So that's what all your future drilling.
We did see some fracture. Yeah, we saw some fracture stimulation impacts between those two, between the upper and lower, and that's why we feel confident on that.
Yeah. Hey, go back to a slide that shows all your acreage, even that part to the east. Go there.
Oops.
Okay, right there. Yeah, all this part that's over in the southeast there. Now, they're not giving you any probables or anything down there, but that's still all held by production by the Exxon wells.
Yes. Yeah, by the Woodford production down.
Okay, so that's really good. So you don't have any drilling obligations over there or anything. You just let it play out.
No, not at all. Yeah, it's that we have 98 or 99% of our acres is all HBP down here.
Okay, so that you got that one well that's kind of out to the east. How's that well doing? And
that one wasn't great. There were some fractures in here. There's kind of a geological structure in here that we think tied into this. So we had some lineaments and some fractures that we think we didn't get a great fracture stimulation job out here because of that. Okay. So that's why we want to step over that geological side of things and see how they do out here, because it's a little quieter geological environment in this area here than it was over here.
Where are the wells on this that are getting completed in the first quarter?
We haven't announced where that is yet.
Oh, okay.
For a couple of reasons, but yeah.
Is there still acreage, or is there stuff available out here?
No, it's us and Exxon.
Oh,
that's it. So,
well, would Exxon, are they considering the upper zones now, or what are they doing?
They're not doing much here at all right now. I think their focus is
because of the gas prices. Yeah, the gas prices.
Yeah, right. Gas prices, and they're really obviously focused on Permian right now.
Yeah, I know.
and South America.
They got a big project ahead of them.
They do have a rig running to the southwest of us by I don't know 10 miles or something. And I facing over.
Yeah, when I was at Heskos, I was the assistant controller over the US E&P division, and we were buying all these acreage and everything, and the guys in New York make these deals, and then we're supposed to do all the actual work. But when you merge with a company as big as Pioneer, I don't care if you are Exxon, that's a lot of work for the accounting group and the land records people, man. They got a lot to do. So. Anyway, okay. So you really have kicked off your 2024 drilling program, correct, with this first 3-well pad?
No. This will still be 2023. The well that we'll start drilling in December would technically be our 2024 program.
Okay, but you haven't announced any like a 12-well program or anything like that.
No, we haven't yet. So we wanted to see the results of everything, make sure everything's going okay, get a good feel for where oil kind of stabilizes out so we can make our assumption for the year. Then we'll make recommendations to our board. And
Okay.
then after that, we'll announce what we're doing. But like I said, everyone's on board with starting the next 3 pad no matter what. But it's just a matter of how many wells do we drill next year.
But you,
I
when
mean,
you,
our cash
okay,
flow
so
should be up, so we should be able to drill more wells than we did this year, is what I like to say.
yeah, but I mean, you could go and just keep the drilling rig busy and drill 3, move it, drill another 3. You could delay the completions to live within cash.
Yeah. We could. I mean, if we get a better deal on something, right, by keeping the rig, we can do things like that. Just
okay, that's
it's just
good.
a cash flow. We want to stay within cash flow without taking down a ton of debt.
Yep.
And so that's what that is. That's just
Because I don't have any problem with building up a good quality duck inventory. That's for sure.
Yeah.
Then you can take advantage of some higher prices. One thing I want to do is to point out to everybody on here that Canadian reserve report requirements are more conservative than SEC when you're in a period of price volatility like we have, because SEC guidance is based on the previous 12 months. So the U.S. companies' year-end reserve reports show like $94 oil, where you showed on there your reserve report is based on forward-looking, which are more conservative by Netherlands Sewell. So that PV10 value that I show there of 1350 or something, whatever per share, is very valid at today's oil prices.
Correct.
Yep.
Yep.
Okay.
I agree.
A couple one of these. Let's see. Oh, at $80 WTI, how fast do the wells pay out of their drilling and completion costs?
Well, our wells last year, right, paid out in, at $80 oil, it'd probably be, I'll guess, 7 or 8 months.
Wow.
On last year's wells. So the downspaced wells aren't going to do quite as well. So it'll probably be closer to I'll say around a year-ish.
Okay.
Just because we're estimating 75% of what our last year's wells did, right?
And after a year or two, we're on your decline curve. Can you go to that? Where do they kind of settle in at?
So we think that they'll be, so here's 2 years, right?
Yeah,
so
150
that's 150-ish. So, right. And
Okay.
3 years, you're, a little over 100, 110, 20 or something like that. We think we'll be above this line. Even their wells this year on this dark blue line.
Yeah.
Even that little bit higher makes a big difference on the economics.
Oh yeah. And of course the oil price makes a whole lot of difference too.
Right. Yeah, for
okay.
sure.
It makes a hell of a lot of difference.
Yes, it does.
I get asked this all the time. They said, what's the break even cost? What's a break even oil price on these wells? And I said, well, the break even to actually be cash flow positive is only like $15. But to pay out the well costs, yeah, you need $50-$60 to do it.
Yeah,
but
what I like to say too is when we were looking in 2021 to drill our 2022 wells at the lower type curve here, right, of the green line, we were estimating a $65 oil price. And it made a lot of sense for us to drill wells at a $65 oil price with this decline curve. So anything that we can do better than that is just better. And like you said, operating wise, our lifting costs are $6. Right?
I know.
So
it's
even
incredible.
when oil went negative, we kind of went, you know what? It doesn't make sense to shut anything in. Right?
I know. If I look at my forecast model and I add in all expenses, G&A, interest expense, all cash expenses, we're talking like $12, aren't we?
Right. Yeah, it's got to be in that range somewhere.
Yeah, $15. You're still cash flow positive, and that's why for small caps, for you guys on the call, why I am so excited about these small caps that are growing within cash flow, because if you don't have a lot of debt sitting on your balance sheet, you can always survive a period of a pullback in the oil price, because you can just even if you got a drilling rig contract, you can keep completing these wells. You could case the horizontal, but you don't have to complete them right away. So you can adjust your CapEx if you have to. So
absolutely.
So that significantly reduces the risk of these companies once they get to funding their growth with operating cash flow. And this is pretty strong growth. I mean, based on if oil stays at 80, 85 next year, my 2024 forecast, you should be able to fund a 12-well drilling program fully out of cash flow.
I'm not going to argue with that on that.
You're not going to argue with it. I mean, I know your board hadn't approved it. I know your board approved it. I'm just saying the dollars
Right.
show that you could do
Yeah.
that. If the well costs are $6.5 million, easy.
And to tag onto that a little bit, you know, one of the motivations for getting onto the NASDAQ proper is to give us more exposure to people, right? Because look at, I mean, you obviously cover us, so you've introduced us to some of your group.
Yeah.
But the only coverage we have analyst-wise is Roth Capital, right? We don't have any other coverage. And the reason for that is because we haven't needed to raise money, right?
Right.
So banks aren't that interested in doing much with us because they see that we can just grow on our own. And, you know, Roth believes in us, and they're doing the right thing for their people that follow them, right? By joining us early, even though, you know, we haven't paid them, right? So, but it's harder to get companies like that to get analyst coverage, to get our name out, because we haven't needed to raise money.
Yeah. Again, a reminder, that's why you pay big bucks for your EPG membership. I don't get paid by the companies for anything. I just get paid by you guys to find these. So, and that, you know, raises a question, what can you do to raise awareness of the company? Just go to more conferences and stuff and just get out there, right?
Yeah, exactly. Get out there and, you know, just like you said, and it's word of mouth to a degree, right? Ringing the bell on NASDAQ, I'm sure will spread around a little further. We'll do some more IR work on spreading it electronically as well, right? What we were doing, and that we're now on the NASDAQ. A lot of people didn't realize we were public until they saw that.
I know, they don't even realize you're public. Yeah.
So that we were, you know, on the OTC already, or we've been on the TSX for a long time. So it's going to slowly hit more and more radar screens. It's going to take a little while, but you know, slowly by slowly, and we've got some other thoughts in order to market, to get out there, in order to talk to more people and get the word out. And like I said, it won't happen overnight, but the NASDAQ listing was a big first step.
Well, and as you get over 5,000 barrels a day and grow from there, you're going to get a lot more coverage. I guarantee you. You start showing up. And another thing I guarantee is, since you were primary listed on the TSX, a lot of people look at the company and they would think all your stuff's in Canada.
Right.
And now that you're on the NASDAQ, they're going to take a harder, it's all in Oklahoma. Oh, it's all real close to the Henry Hub, and, you know, and are not Henry Hub to Cushing. So they're getting good price for their oil and blah, blah, blah. So that helps. So.
And the whole team is in the US, right? Our entire team is in the US. Even our board, all of our board but one is in the US.
Okay.
So we're really kind of a US company. We just happen to have a Canadian listing.
Yeah. So you'll get a lot more volume on the NASDAQ that way. Okay. Let's get to some of these questions here. It says, Matt, I'm curious about what the timing of the PUD location development versus step out drilling looks like in the coming years. Seems like there are still plenty of PUD locations left to continue focus on developing in the core area before, you know, stepping out to drilling, even if it's really needed. And since all your acreage is held by production, you can, you know, focus on the sweet spot of the zone and just gradually step out, because you have no drilling obligation. All these leases are held by production, so that's great.
Correct. Yeah. So it's at our discretion, right? So eventually, I'd say probably toward the end of next year, maybe we'll plunk one down out here, but it'll be a single well out there, right? It's not going to even be a 3-well pad, just to see how that works, how economically it is. And then we'll need production from 6 months or so out of that to evaluate it. And then if it works out well, then we start drilling more out here. But we'll also start drilling out on the west side, which, even though it's not proved, we think it's low risk out here.
On your acreage, what's the deal with the Sycamore? Has it got potential below the T-zone?
I don't really count on that. We do have the upper Sycamore. We don't have the entire Sycamore, but it's pretty tight. The Sycamore does produce up as we go to the northwest from us here, and the other parts of Scoop. But geologically, not in the Sycamore, but the Caney is so different where we are than where it is up there, that we are really in a unique Caney itself, and it's really on our acreage and Exxon's acreage. They have the Caney up there, but it's a different animal. It turns much more carbonaceous.
Yeah.
Well, and that shell that we have here. So the Sycamore is a little different as well. It might work in a couple areas, but I don't really count on it. We haven't seen anything that tells us that, we want to go drill this, much like we have in the T zone, or even the false Caney looks better. That's just above us too, than the sycamore from our point of view.
Okay, good. But that, that's the beauty of held by production. I cannot stress enough, folks, is so important, because then you don't have to take risk just driven by your leasehold expiration dates. You don't have to do anything. So you can develop the field on a much safer and ramp up production much safer. So anyway, that's great. Where are we on the three current wells? Have they been drilled and completed? I don't know if you mentioned that, but I think you did. Anyway.
Yeah. So the latest 3 wells, the Emerys, they've been drilled, and we'll be fracture stimulating them here in November. So they should be on by the end of November, hopefully, or right around that time. Late November, early December.
Okay, and then before the end of the year, you're going to be drilling on the next pad.
Correct. Starting on the next pad. Correct. Yep.
Okay, now here's a international question. What are the potential impacts on Kolibri and other producers if U.S. imports from Venezuela increases as a result of the temporary easing of sanctions? I'll give you my 2 cents for it first. This is purely political. The amount of additional Venezuelan oil is like a rounding error in the global oil supply. At most, they could probably ramp up another 200,000 barrels a day. And we absolutely need that heavy oil, because our refineries are made to handle more heavy oil. We should have finished the Keystone XL pipeline and gotten more heavy oil from Canada, but our current administration did not. So they are sucking up to Venezuela. And if you think that they're going to have fair elections just because they signed a piece of paper, you're crazy. But go ahead, Wolf, give us your 2 cents.
Yeah, I agree completely. I mean, if you look at Venezuela has their heavy oil reservoirs, right? And so they've been shut in for a long time in pieces of it because they haven't been able to keep up their infrastructure or anything else. I've got a lot of heavy oil steaming experience from California operations from years ago as well. But so if you shut in a steam flood property that's heavy oil, it takes a lot of work in order to get that back up. It doesn't happen overnight, and you have to recharge the reservoir. You have to reheat it. You often have to drill new wells. If you look at Iran, that had the similar issues. When they shut things in, it took them years to ramp production back up again. So I don't see that's an overnight thing. And as you mentioned, a lot of the crude we export is because we have to import the heavy, right? So
we're exporting light to import heavy.
Yeah, right. So I'm on the same page as you are, Dale.
Well, and I will tell you, when I was at Hess, we looked at a company called Lasmo out of the UK. We were going to buy them. We sent a team down to Venezuela to look at their and if we would have bought that company, it might have bankrupt Hess, because a few years later they nationalized and just would have taken all those away. And our team that came back from there, they said they had never seen a worse environmental thing, that the oil was all over the ground. The gathering lines were on top of the ground. Oil was spilling out all over the place. They said every other joint was leaking oil. It was terrible. So here we are. We got the administration fights the development of U.S. oil, and they make some stupid political deal with Venezuela. It's just trying to talk down the oil price, folks. Don't buy this junk. It isn't going to do anything. Okay, moving on. How did the company get its name, and what is the correct pronunciation?
Yeah, so I don't care which way you pronounce it. I call it Kolibri. Okay. So Kolibri means hummingbird in a number of European languages. We're changing the name from B&K Petroleum to Kolibri because we're on a new path of developing this field and just focusing on cash flow and everything else, doing less on the wild exploration stuff that we did in the past. We went to Europe in B&K, so people were knowing us for that. I wanted to focus everyone on what we're doing now. Different company, different way of looking at things. And so that's why we're looking to change the name. We went from petroleum to energy just to be a little bit more politically correct nowadays. And went with, like I said, hummingbird, green wings.
Oh yeah, it's that little hummingbird up in the corner. Okay, yeah, I got it.
So that's our logo. So,
that's your logo. Yeah. And I've heard it's called Kolibri, but
right. Whichever one you want to do. Yeah, exactly.
Yeah, maybe depends the French
on which pronunciation you're looking at. Yeah, that's possible. So I've got a German background, so for me, it's Kolibri in German and some of the Spanish languages as well.
Yeah, everybody, my entire family was German, and everybody that lived around us was German in St. Louis. Anyway, oh, you got a new shareholder. Bill says he's going to open up a position in the company. And then I guess the last question is here, roughly when can we expect third quarter results?
So those will be we'll release after November 13th after market, and we also have an earnings call on the 14th of November.
Okay, great.
We'll put out a press release too for a link to for people to be able to dial into the earnings call.
Yeah, I will be on vacation I'll be on vacation in Mexico that day, but the following week I will update your my forecast model for the company, and we will be publishing an updated profile on the company in the middle of November sometime. So that'll help get more exposure. I will tell you guys, Wolf, and that our podcasts do get a lot of exposure. That's why we like that first screen to say EPG. We've had some of them get several thousand views because once it goes public, these recordings are only available to EPG members for a couple of weeks. And then after that, they go public on YouTube. And then we start to see a real uptick in the number of views. So that should really help get the company more visitation of potential investors. So anyway, I think that's good. Wolf, great job. I'm really excited about this one. I do personally have a position in the company, so I'm going to follow even closer than usual. But that's it. So Sabrina, why don't you close it? And thanks again, guys, for being on here.
Yeah, thank you. And thank you everyone for listening.